Hi, my Bitcoin followers! The 4-year cycle is so important. Here's why. On January 3, 2009, Satoshi Nakamoto launched the Bitcoin network by mining the first block, the Genesis block, in the Bitcoin blockchain. Today, a bit more than 12 years later, the network stores over $1 trillion in value and transfers more than $20 billion in on-chain volume on a daily basis. To get there, Bitcoin went through multiple boom and bust cycles in which it was praised to the moon and declared dead many times over, every time to resurrect from the dead. This process kept repeating in a rough 4-year cycle that led many to believe that there is a certain predictability to long-term Bitcoin prices, of which Plan B's popular stock-to-flow S2F model is the most well-known attempt. So, in today's video, we're going to take a look at why the 4-year cycle is so important. Without further ado, let's begin. Make sure you enable all notifications to our channel, give this video a thumbs up, and don't forget to subscribe. And stay tuned for the hottest secrets and information of Bitcoin. When Satoshi Nakamoto launched the Bitcoin network, there was a need to bring the Bitcoin units into circulation and incentivize early users to actually participate in the network by running their own mining nodes to secure the network and gradually decrease the chances of a single entity attacking the network via a major attack, or 51% attack. To do this, Satoshi Nakamoto decided on a coin issuance schedule where Bitcoin network participants would receive a 50 Bitcoin mining reward, also called Coinbase, not to be confused with the eponymous exchange, per created block. Every 210,000 blocks, this reward halves. After the first halving, November 28, 2012, miners received 25 Bitcoin. After the second halving, July 9, 2016, 12.5. Since the last halving, May 11, 2020, they received 6.25, and so forth. Intended or not, the roughly 4-year halving that has occurred 3 times in Bitcoin's existence so far appears to have been consistently triggered in pushing up the price every time. After every halving event, the Bitcoin price has moved up dramatically in the year after those events. The average Bitcoin price during a 4-year moving window has been positive during its complete lifespan as a result. Before each halving event, the Bitcoin price is a dynamic equilibrium between the supply of newly mined Bitcoins that enter the market and the demand for Bitcoin by new market participants and recurring purchases. After the halving, the supply of newly mined Bitcoin that enters the market is cut in half. If the demand for Bitcoin remains unchanged, this means that the supply shortage is gradually formed. Since Bitcoin supply is perfectly inelastic, this supply shortage cannot be solved by creating more Bitcoin. As a result, the only way for the market to unlock supply to satisfy the demand for Bitcoin is to entice current holders to sell their Bitcoin, which means that the market price has to move up. Due to Bitcoin's status as a Veblen good, this rising price tends to attract even more demand, exacerbating the already existing supply shortage and driving up the price much faster than it organically would. Those price developments resulted in a temporary bubble each time that ended with a market crash and subsequent multi-month to multi-year bear market that was necessary for supply and demand to find a new equilibrium, each time at a much higher level than during the previous cycle. Although the post-halving price increases, the Bitcoin price charts are already pretty distinct, and the causal mechanism for such a cycle to exist is quite self-evident. It is nice to get more robust evidence for the notion that the Bitcoin price indeed moves in a 4-year cycle. Bitcoin price temperature is calculated by subtracting daily closing prices by the average Bitcoin price during the previous 4 years, and then dividing that number by the price's standard deviation during the time span. The result is a metric that reflects to what extent any historic Bitcoin price deviates from its 4-year moving average while taking its volatility into account, and, thus, how hot or cold the price is. In anticipation of each Bitcoin halving, articles and videos are spreading fear, uncertainty, and doubt (FUD) about something called the mining death spiral start appearing. The mining death spiral FUD suggests that since the block subsidy is split in half, miners are faced with a 50% cut in their profitability, which will cause some of them to stop mining. In turn, this would make the network less secure, making it less valuable, making the price go down, further decreasing miner profitability, making them turn off more miners, and so forth. While it is true that in the short term, some miners are turning off hardware that is less efficient or running on more expensive energy, that dip is barely visible on long-term charts and ensures that the remaining mining activity on the network is actually very efficient and healthy. More importantly, that temporary dip is actually completely undone by the positive side effects of the halving-induced price increase that was described earlier. As a result of the increasing Bitcoin price following the halving-induced supply shortage, mining profitability increases again, incentivizing miners to rejoin the network. As a result, the network's hash rate actually increases, making the network more secure and thus more valuable. This means that on a multi-year horizon, we are actually seeing the complete opposite of what the mining death spiral FUD suggests will happen, all thanks to Bitcoin's 4-year cycle. Intuitively, the first thing that you might think of to visualize the behavior of that group might be to create a chart of the number of daily transactions. If we were to do so, we would indeed see an overall trend that, as time passes, more transactions are made on a daily basis. But as the Bitcoin network matures, that growth stagnates. That stagnation can be easily explained. A Bitcoin block can only include a certain amount of transactions, so the metric wouldn't be an ideal proxy for how crowded it actually is on the network. What happens when most or all of the newly created blocks are full is that the number of transactions that are queued up increases. In Bitcoin, this queue is called a mempool. As is evident based on that, the number of transactions that are waiting to be included in the blockchain have increased rapidly after breaking the all-time high price of $20,000 in December 2020. The mempool is currently in a state where it hasn't cleared in approximately 5 months, which means that when any miner created a new block during that time span, they had plenty of unconfirmed transactions to include in the block. A logical conclusion is that miners are financially incentivized to include the unconfirmed transactions that are offering the highest transaction fee to reward the miner for including their transaction, which is indeed how most of the current miners operate. As a result, unconfirmed transactions with a high transaction fee are included in new blocks first, while transactions with a low fee remain stuck in the mempool longer. As such, a block space market, sometimes called free market, which is technically incorrect because the block space on the Bitcoin blockchain is being bid on, develops. Make sure you enable all notifications to our channel, give this video a thumbs up, and don't forget to subscribe. And stay tuned for the hottest secrets and information of Bitcoin.